What's up, everyone, and welcome to the daily macro update for Thursday, November 6th. Having a little bit of a correction today in the markets, mostly from some of the mega caps. We'll be getting into that, as well as the big macro news today, which was that we saw a pretty decent announcement of job cuts, especially in the tech sector. So we'll go ahead and get into that. Thanks, everyone, for joining here today. We're going to be getting into some good discussions here. If you guys haven't already, share this video with a friend, tap that like. It gets the algorithm going here. All right, so we saw that this month in October, the amount of job cuts reached a 22-year high. That is mainly coming from both government layoffs as well as the tech layoffs. And so when we take a look at the Challenger job cuts, which is the measurement and the private data that tracks this, you can see a pretty decent acceleration. But the main concern was coming from the amount of layoffs that were announced. So it's not just the amount of jobs being cut, but it's the amount compared to other Octobers from past. And as we can see here, this is the highest October since 2003. And again, this is mainly coming from, warehousing, government, as well as the tech sector. And that's been one of the biggest concerns with the labor market is that, with all these kids who are graduating from college, they're having trouble finding work because a lot of these entry-level jobs are being taken over by AI. And so you're having a disgruntled youth in the United States, but also as well, you're seeing a large amount of boomers retiring. And at the same time, you have the immigration policy from this administration, which has contributed to negative immigration. And so all that combined has caused a major shrinkage in the labor market. And so even though the current level of the unemployment rate is low, it's artificially low because the entire pool of the labor force has shrunk. And so one of the interesting things is that during the press conference of the most recent Fed meeting, Jerome Powell said that he's not seeing too many cracks in the labor market, and this completely just wipes that out of the way. And so when going to the Challenger Gray and Christmas website, I hate the way that this is laid out. So whenever you scroll, it like jumps to weird places. So whenever the Challenger report comes out, I go straight to the website and I scroll all the way down to the bottom where it says download the full report with tables. I always recommend doing this because the website is just absolutely horrible. But when you get the PDF copy of the report, it gives everything in a pretty detailed highlight here. So as you can see right here, the title of this is Job Cuts Surpass 1 Million, Highest October Total Since 2003. Companies Cite Cost Cutting and AI in October. And so that's one thing that we've seen that we haven't seen so far with this labor market is layoffs start to increase. But I think from here, as we're seeing from a lot of these major tech companies who are trying to cut costs, we are finally at that last leg in the cycle where all things have been used in terms of methods for not having to end up laying off people. And so we're at that point now where companies are finally left over with having to do layoffs. And so that's what we're seeing here. Just to read from the report here, October's pace of job cutting was much higher than average for the month. Some industries are correcting after the hiring boom of the pandemic, but this comes as AI adoption, softening consumer and corporate spending, and rising costs drive up belt tightening and hiring freezes. Those laid off now are finding it harder to quickly secure new roles, which could further loosen the labor market, says Andy Challenger. If we keep on scrolling down here, we can see that through October, employers have announced 1.1 million job cuts, an increase of 65% from the 665,000 announced in the first 10 months of last year. That's up 44%. And so year to date, these are the highest levels since the pandemic. Not really a good sign in terms of the jobs market. So continuing to read here, not only did individual companies announce large layoff totals in October, but a large number of companies announced job cut plans. So it wasn't just the raw numbers. A lot of them have then guided to say, hey, we're going to continue these job cuts into the future, which really is painting a very poor picture for the labor market. And so I think that is why we're seeing the bond yields come off the top end of the trading ranges, which we'll get to here in a second when looking at the charts. But, when we take a look at which industries are cutting the most, it's tech and retail. Technology continues to lead in private sector job cuts as companies restructure amid AI integration, slower demand, and efficiency pressures. In October, the sector announced 33,000 job cuts, up sharply from the 5.6K in September. For the year, technology firms have announced 141,000 job cuts, up 17% from this time period last year. So that, as well as, part of the reason why they're cutting, again, is mostly AI, as well as they're tightening their belts. And then, like we mentioned earlier, employers have announced 488,000 planned hires, down 35% from 750,000 announced at this point in 2024. So this is the lowest year to date since 2011 on job hiring plans. All right, we've beat that dead horse. You can see that the jobs market is incredibly fragile, and it almost makes you wonder, is there a reason why they, want to shut down this government in order to kind of delay a lot of the poor numbers that we're clearly getting from a lot of this private data in terms of the jobs market? As we know, the first month of every single month, or the first week of every single month, is jobs week. So in terms of macro data releases, the first week of every single month is the jobs numbers from the previous month. And so far, this is now the second consecutive month since this now record government shutdown. And it is quite convenient that those numbers aren't being released at this point in time. So that's kind of what we're seeing here today. How does that translate over to the markets here? Well, the one thing that I've noticed is that the volatility index of the S&P 500 is pushing up to 20, which typically, if it's able to hold here, you're able to find a bunch of different things on sale. Mainly, the largest, things that are having a pullback here are the large tech companies, as well as Bitcoin. Bitcoin is in bearish trend, so we're not even looking at that. But taking a look at the S&P 500 here, we can see that it's having another correction here, still maintaining bullish trend. But this is having a price decline on okay volume, still lower than average. So again, this is a buying opportunity for those who track and are a part of our free newsletter called the Daily Index Ranges, which you guys can sign up for free. It's where you get an email every single morning at 8:30 a.m. where it gives you the ranges, the trading ranges for the S&P 500 ETF SPY, the NASDAQ ETF QQQ, and the Russell 2000 ETF IWM. If you're interested in that, just go to our website, macro-optics.com. On the homepage, just put in your email so we know where to send it every single morning, and you'll be able to get those. But yeah, as we're seeing right now, pretty nice little correction here near the low end of the trading range on decent volume, but not seeing a large spike like we did on October 10th. If you're looking for more of an opportunity when looking at Qs, that's what we're seeing here. The biggest correction today is from NVIDIA. So right now it's at a price point of 187. I was buying a little bit of this as well as some Qs, so we'll see if it's able to have a bounce here. Still maintains bullish trend. We'll see what happens, but semiconductors opened up today, up on the day, which was pretty interesting. So it provided a little bit of a sell opportunity before, during the same day, now almost closing here, 1 minute left in the markets. We're now having an opportunity to buy some back here. So yeah, pretty much a brutal week though so far, as when we take a look at the main components that my team and I like to track when looking at the 5-day performance here, you can see that the majority of these assets are negative for the week. So gold, silver, small caps, S&P 500, oil, Bitcoin, all having decent moves down, and a dollar that is bullish trend. When taking a look at the mega caps here on a 5-day trending basis, you can see that really the only thing that's flat is Google, and everything else is down on the week. The most being NVIDIA, now down nearly 900 points, or almost 9% down. Meta, Broadcom, Microsoft, all of these are having a correction here. Google is the most positively trending asset of the Mag 7, as well as Apple. So yeah, pretty decent correction we're seeing in things like consumer discretionary, as well as the mega caps here. One of the best ratios that I like to look at in terms of risk on versus risk off environments is this XLY versus XLP ETF ratio. And as you can see, we're just having a correction. Still remains in bullish trend, so more so of a risk on environment for select assets, not all of them. But in terms of this, what we're seeing here today, it's pretty much just an opportunity to buy some mega caps so long as the volatility index does not continue higher from here. So still got to see that. But this jobs report, this job cuts announcement, it's getting the dollar as well as bond yields off of the top end of the trading ranges. Bond yields are in bearish trend, which means bond prices are in bullish trend. So things like TLT provided a decent buying opportunity the other day, and it's up today. Now that bonds are continuing its bullish trend here as bond yields continue lower, and that's pretty much what I'm seeing here today. One thing that is also interesting is that when taking a look at central bank liquidity, there was a lot of people who were bringing up this right here, which is the reverse repo overnight rate and how it had a huge spike, and that has pretty much come down. So the whole banking fears that were happening with cracks in the banking market, those have pretty much been subsided, and we're not necessarily seeing too much risk there. Even when looking at credit spreads, yes, they're elevated, but still remaining, at historical lows. So, I don't think that this sell-off that we're seeing in the market right now is cause for too much panic, but we're still not seeing any type of major spikes in credit spreads, as well as a huge major spike in volatility. We'll see what happens on Friday. Fridays are typically notorious for being a pain in the butt. So, we'll end up seeing what happens right there. But my team and I were buying some mega caps here today on this nice little dip. But what's interesting is that, over the past few days, we've been in this type of good news equals bad news environment. And because of that, we saw bond yields get pushed higher, as well as the 5-year break-even inflation rate, which is the bond market pricing in the average inflation rate over the next 5 years. And that had a pretty decent pop since October 17th. And now we're having a nice little, reduction here. So still failing to see this really have any type of move down. If this would have continued on from the middle of October, that could have been a huge recession risk. But what this is mainly showing is more of that stagflationary environment that we were seeing beforehand, where, you have a weak labor market, but it's not it's not imploding, even though it could be in the next few months here. But you're also seeing inflation remaining near 3%, which is well above the Fed's target. And then what's also been gaining some strength here is some of these inflationary type of commodities, mainly silver, as well as gold. These are starting to settle down a little bit. And one thing that I like to see when taking a look at these gold ETFs, this one here, GLD, look at what's been happening to volume. Volume has been declining as this has kind of been, pushing sideways here. So when prices decline on lowering volume, that's a bullish divergence. Now, this doesn't mean that I'm adding more to my gold positions, holding off a little bit on that. But if we do get an opportunity here where this has a price increase on higher volume, that would definitely be a good sign. And then once that has another opportunity to come down after that price spike on lower volume, then that's when I'll probably start to add more aggressively. But what's interesting is that we could be going back towards that stagflationary environment where liquidity is even more tight. So that's what I'm seeing here in the markets. Taking a look at the yield curve. So this is more of a medium term aspect. For those who are new to the channel, one thing that my team and I like to track in detail, and it really is one of the key contributors towards our entire investment model, and that's paying attention to what the yield curve is doing, because the bond market is probably the most important market to look at in terms of what it's trying to price in. A lot of investors and economists call the bond market smart money because that's where a lot of large, wealth managers as well as wealthy people are holding their money in this cash equivalent asset because they generate a yield almost risk-free depending on what they're investing in. But if you pay attention to the signals from the bond market, that would give you a very good idea of what these big players are trying to price in terms of growth, inflation, recessionary risks, whether we're going back into expansion, whether the Fed is going to cut rates or not. Everything is being priced into the bond market and is one of the most important signals to look at. Now, this is kind of zoomed in here, and you can see these different color patterns, which I've talked about in the past. I'm thinking about doing a video where I go into a deep dive of all the different phase transitions, and all of them mean something. All of the different phase transitions tell you about which assets typically perform the best. Again, this is something that we go into detail with in our macro investing community. But when zooming out a little bit on this yield curve, what you can see is that ever since April 15th of this year, which was when you had a large acceleration in this steepening, which was when the market was having a correction, ever since then, this has pretty much pushed sideways in what's called a bull flattening performance, which typically signals that growth is starting to subside as well as inflation could follow as well. This is when the long end of the yield curve is dropping faster than the short end of the yield curve, which again typically signals more of a weakening economy. And that's been happening pretty much for the past 6 months, 8 months. And when taking a look at this, the next thing that you have to think about is, okay, what's the next phase that we're going to head into? Typically, after a flattening like this, you head into some type of steepening effect, whether that's a bull steepening or a bear steepening. Now, a bull steepening is typically what happens when we are in this later stages of the economy, which is when something breaks and the Fed has to cut rates dramatically in order to save the markets and have that emergency injection of liquidity. And that's really what the entire crypto community has been waiting for. That's what a lot of these different people who are trying to time bottoms are waiting for. The only thing is that initial jump from something breaking in the markets and the Fed cutting rates and flooding the markets with liquidity, that initial drawdown is what you want to avoid. It's the aftermath and the after effects of that come a few months later that you want to make sure that you are positioned for. And what that translates to when looking at the yield curve here is a pretty steep acceleration, and the background of that would be green, similar to what we saw during the correction back in March of this year. And so you'll see the yield curve do this and the background go green, right? Because that's what would be called a bull steepening. And just to give you a visual of this, when taking a look at the S&P 500 in blue here, you can see that when we had that huge price correction, what did the yield curve do? It had a very sharp steepening. When we overlay that with, in yellow here, this is the volatility index of the S&P 500. I know it's kind of getting crowded here, but you just have the three things: the yield curve in white, the stock market in blue, and the volatility of the stock market in yellow. When you have volatility rise, stocks start to weaken, and then you have that bull steepening effect in the yield curve. That's where you want to be able to get out of the way. And that's part of the reason why, when we started to see this back in early or late February of this year, that's when our model went bearish on the S&P 500. And that's really what our team is looking for as we go forward here and we start to get more risks coming about in the markets in this later stages of the business cycle. And so we're not at that stage yet where we are bearish on the S&P 500. For those of you that are new to the channel, the background is green there on the bookshelf. I changed the color of that bookshelf depending on what our model has the trend in the S&P 500. And so when when that bookshelf is the color red, that's how you'll know when we are bearish on the S&P. And I'll also talk about it on the channel too. But, we're still remaining bullish. We could have this type of yield curve flattening for quite some time. And really, this flattening is being interpreted by the market as a potential soft landing, which always happens. But if we continue to push sideways in the yield curve, you could just continue to see this no landing scenario that happens where the stock market continues higher. So I'm not sure how long this bull flattening will continue, meaning, doing this. But at some point, this will steepen, and it's really going to depend on how that steepens. And, if history is a tell, and, typically history rhymes, this steepening effect will be due to some type of large correction in the markets. And at that point, you want to be steering clear of that. And in this post-pandemic environment where, it's very unpredictable, the macro environment, paying attention to macro is what's going to differentiate someone who is going to be able to avoid this and take advantage of when that dip actually happens versus someone who is just blinded by, the classic methods pre-pandemic that don't really work, right? And I'm sure some people who are watching this have experienced that where it's like, what the heck? I haven't even made any money this year or whatever. And, something needs to change. Well, it's probably because you're not paying attention to the macro as close as you should, or you're not incorporating macroeconomics into your strategy. But that's okay. I mean, that's why you're watching this, right? So that is what I am looking at here. When taking out the yield curve compared to 1 year ago, though, what's interesting is that on the long end, it's pretty close on the 20-year bond yield. We've had a little bit of a drop off on the 10-year. But the real big drop off has been on the 2-year. And so growth and inflation expectations really have remained flat, but you've gotten a drop in the short end of the curve, signaling that the Fed is continuing to cut rates. And so, from this, you can see that the Fed is really in a hard spot right now that they themselves got themselves into. But if they cut too fast, they're just going to keep getting this stagflationary environment. But if they cut too slow, then, it could cause too much tightening in the markets. So the farther we go through this end period in this business cycle, the harder it's going to get. And I used this analogy a couple months ago, and I haven't brought it up in a while. Maybe I can pull up the picture while I'm talking about it. But for those of you who grew up on some of the older video games on either Nintendo or Xbox, one of my favorite games was the original Tony Hawk Pro Skater. And one of the hardest things was, when you're approaching a rail in the video game and you are trying to break a record for, how long you can, grind the rail. The harder or the longer that you grind on the rail, the harder it is to balance. And I bring this up. This is one of the newer versions that they made, but the longer the rail is, the harder it is to balance that scale. And this is what the Fed is doing right now. This is like a perfect representation. The skateboarder is obviously the Fed, and the longer this crazy cycle is, the rail, and that scale is going to tip either way. And whichever way it tips, the Fed or the skateboarder is going to fall off the rail if it goes too far on the other side. Tight too much, and the skateboarder is going to fall. If you cut too much, inflation is going to get crazy, and the skateboarder is going to fall either way. So at some point, the rail is going to end. And that's really what the Fed is trying to do, is they're trying to work with the government to extend that railing as much as possible to buy time. And that's essentially it, because they're trying to achieve that soft landing, which is possible. The skateboarder could, come off the railing and not fall, which is a possibility. But that's the thing. The longer that railing is, the harder it is to actually land the trick. So that's what we're looking at here today. So what we'll do is we'll get into some questions. Appreciate everyone for joining. Also, as well, if you guys want to start learning, a lot of this macro process, we have a 6-week challenge going on with our macro investing community where you get access to our partnership circle for free. And if you want to learn more about that, just go to the link in my bio where you can book a strategy session with myself. Just go to the calendar and pick a time, and we can review everything on a call. And it is me. It's not someone from my team. It's actually me on the call. So if you're interested in learning more, we can have a casual discussion there. But let's go ahead and get into the comments here. I appreciate everyone for leaving some comments. We'll go a little bit longer here today just because there's no stream tomorrow because it's Friday. I got to get a haircut, okay? I'm 32 years old and I got these crazy grays coming in. My wife hates it. My father, I look at pictures when he was younger and he went gray pretty early too. So I don't want to dye it, so I'm just going to shave off, the sides. I don't know if I'm ready for the gray yet. I don't know. Maybe I'll have to rock it. Who knows? But Fridays are usually where I do my appointments, whether that's like dentist, haircut, whatever. It's an admin day, okay? I don't want to do it on the weekends. Plus, you get me on Sunday nights too, so I'm just kind of shifting the days there. But all right, let's go ahead and get into some of the questions here. We'll start with YouTube. Hey, thanks for the good content. Keep going. Appreciate it, Mr. M. What are your thoughts on today's Bank of England published outlook? I'm not sure what you mean. What are your thoughts on Atlanta Fed's GDP at 4% for Q3? We can bring up the nowcast. That's a great question. All right, so what are your thoughts on the Atlanta Fed's GDP nowcast for 4% for the year of Q3 or for the quarter 3? Now, what you have to recognize is that GDP isn't the same as other types of metrics. So when they say Q3 GDP, it means that it's all the data from the beginning of the year up until Q3, and it's trying to predict the entire year's GDP number. So it's not just 4% for the quarter of Q3. When it says 4% for Q3 GDP, it means that it's annualizing the entire year of 2025 to be 4% as of Q3 of the year. And so, seeing that it's estimated to be 4%, it talks about the acceleration in the ISM services number that we covered yesterday. If you guys haven't watched that video, I would highly recommend taking a look at that from what we covered the previous day. But the reason why they're saying that is because, look, you have the government right now that continues to print money like crazy. And that's essentially what's propping up the entire private sector is the government injecting money into the private sector with its insane deficit spending and printing of their bonds, their treasury issuance. Let me see if I can pull up a chart of that real quick as I'm talking. But, as soon as the government stops printing its money like this, then you're going to see a large decline in GDP, in my view. Let me see if I can bring it up here. What was the metric? Let's see. Here we go. 1 second. All right, let me see if I can bring this up here for you guys and gals. Actually, let me shrink it and then zoom in a little bit. Okay, so what this metric is showing here is bond issuance. So whenever, hold on, let me reset this. Okay, so in this environment where there is higher than average interest rates, The Fed, or the government rather, doesn't want to issue treasuries while interest rates are this high because it doesn't want to take on that long-term debt at these high interest rates. It's for the same reason why people are holding off on wanting to buy homes and go into these 30-year fixed mortgage rates with it being, 6%. Why would I do that when I can just wait for interest rates to come down more and then buy a house, at 5%, possibly a year later? Well, that same type of thought process is what the government is doing right now, and that's why they are holding off on issuing debt on the long end of the curve, and they're mostly issuing treasury bills, and that's why you can see right here this huge spike in treasury bill issuance, which really started with the Biden administration under Janet Yellen back in 2023. And what's interesting is that Scott Bessent, the current Treasury Secretary, he was pretty critical of Janet Yellen doing this, and you can see that he's doing the exact same thing. So not really a change at all. Not to get political, but there's virtually zero policy change when it comes to Treasury issuance between the Janet Yellen versus Scott Bessent regime. But the problem with this is that if rates don't come down, the rollover risk of all this short duration debt becomes more of a burden. And the more that they print essentially this money, the more that's going to beef up GDP and essentially provide a stimulus. And so a lot of the GDP estimates that we're seeing today that are elevated are mostly because of this enormous amount of treasury bills being issued by the Fed, or by the government rather. And we're at a point now where they're starting to get a little bit worried, only because they're starting to see a little bit of a drop off in terms of foreign demand of US treasuries. And that's part of the reason also why the Fed announced that they're going to stop doing their quantitative tightening program, because they're going to start to buy a lot of this longer duration debt and shift it to T-bill demand. So the Fed is now going to come in as more demand. Now, it's not quantitative easing, but what they're going to do is still continue to maintain ample reserves in the financial system while also supporting, this treasury demand. But all you have to know is that with this crazy amount of treasury issuance that's going on, that's beefing up the economy. And so when I take a look at this 4% estimated GDP, it is correct because it's looking at all the metrics there, but the cause of this isn't necessarily happening because of organic demand or a thriving economy. It's being beefed up with steroids. So that can only last so long, and the government, the Fed has, or the Treasury Department has said that this is a temporary measure until rates come down. You can go and watch the videos that Scott Bessent has been doing. That's what he's been saying. But this continues. The just insane amount of government deficits that we're in right now. Debt to GDP is at levels that we haven't seen since World War II. It's no surprise that we're getting high nominal GDP numbers. Or I'm sorry, real GDP numbers. So it's all a fugazi. Oh, hey Remy. What's up, dude? The cat is on the camera. Remy boy. What other questions do we have here? What are your thoughts? And we just covered that. Let's see. Does the self color reflect purely on overall market price action or other confluences? Not sure what you mean there. Not sure what you mean. DTX futures. When we eventually get quantitative easing, will it be way less than 2019 to 2020? I'm not sure. Again, I'm not quite sure on the magnitude of when quantitative easing comes back. I'm sure it's going to be larger, only because look, when you take a look at the assets that's on the Fed's balance sheet, with them stopping quantitative tightening right now, the level is at a much higher level than what it was in previous cycles. So let me just go ahead and bring this up here. Let's go to assets on the Fed's balance sheet. Okay. So here's the amount of assets on the Fed's balance sheet going all the way back to 2003. We can see that the current level that we're at right now, 4.2 trillion, this is much higher than the pre-pandemic levels of around 2 trillion, right? It's nearly double. And so with the Fed saying that they're no longer going to do quantitative tightening and roll off and let these treasury securities roll off their balance sheet, they are essentially saying that $4.2 trillion on the balance sheet is the new bottom. And from here, it's just going to expand even further as we get into these crazy cycles. And so similar to what we saw back on the yield curve, let me go ahead and bring this up. So this is going to maintain sideways because, again, this isn't quantitative easing. This is the Fed essentially maintaining that balance of 4.2 trillion because every single treasury that rolls off the Fed's balance sheet, they're then going to take that principal and buy it back in bills, essentially maintaining assets. Now, at some point, when that continues flat and then it goes like this, once it starts to expand again, that's quantitative easing. But, you know, like I mentioned before, you're asking me to guess what the catalyst is going to be for the next market crash, and I just don't know, you know. And it'll really depend if it's something like this, where they, you know, go crazy with it like they did during the pandemic, or if they start doing it gradually and it ends up, you know, at a rate of change like this. So the rate of change of how they bring about quantitative easing is going to be key. And they're going to do it eventually. So this is why I think that ultimately in the long term, you got to own assets, you got to own gold, you got to own Bitcoin, you got to own real estate. If you're holding on to dollars, like, you're screwed. I don't know how else to say it. But this Ponzi scheme is going to keep going until it all goes. And at that point, I'm sure we'll be worrying about other things than the trading charts. But yeah, so good question though. Awesome video. What are your lines for AMD on the 5-day chart? Go with the buzz cut. Definitely not doing the buzz cut. Got to keep the flow going. But when looking at a chart of AMD, I can just bring that up real quick. Yeah, I mean, right now it's near the low of the trading range, and it is in bullish trend. Volume kind of spiked up, though, post-earnings. So, I mean, I want to let it settle down a little bit. But AMD is getting more attractive, for sure. But I'd probably wait a little bit more just to see what happens there. Good question. A bit off topic, but what are your thoughts on the recent Fed conference that happened last week regarding blockchain technology? Why would they have these discussions with major companies? You know, I'm not sure the exact comments, but pretty much the entire theme of why the government is trying to be, you know, the champion for crypto is because they're simply using it. They're simply using it as a way to provide another stream of demand for them issuing treasury bonds or treasury bills. Going back to that treasury issuance chart. The only thing that the government sees crypto as is a way to help this situation right here. That's it. As well as maybe some people from the current administration to make some money off meme coins. Will Fed start to print money in 2026 under the new Fed chair? Maybe. Who knows? All right, let's do some rapid fire on these questions here because I got to go. All right. Looking over at Instagram. I know you're bullish on XLV. What are your thoughts on NUVB? I'm not sure. Let's see what the model has to say. Market cap is only 1.73 billion, so this is too small for my taste. But I mean, you know, just answering your question, it is in bullish trend, but too small for me. United Health, yeah, that's one that I did try and take a shot at, but it's not working out too well. Continues lower. We'll see what happens here, but if we do get a pop in United Health, I'm probably just going to get rid of it because I do not like how it's breaking trend here. So, yeah. Wasn't able to hold. Not what you want to see. But at some point, United Health will bounce. So, how about working toward bond markets? How would they be shaping out with the QT and QE futures of the Fed? Well, if they start to flood the market with liquidity, you're probably going to see, bonds continue to do well as bond yields start to, come down from there. Most economists are negative. Yeah, that's true, but the S&P 500 is still in bullish trend. So I mean, I don't know what to tell you. I'm not going bearish on the S&P until it goes bearish on our model. I don't care what anybody says online. I don't care what your favorite YouTuber says. I don't care what Tom Lee on CNBC says. I do not care. I will remain bullish if my model says it is bullish. Stop, Remy. These cats are starting to eat some of the cords that are on my desk here, so I got to feed these cats. All right, well, appreciate everyone for joining. We're going to go ahead and wrap it up there. Again, if you guys want to learn more about, how to incorporate macroeconomics into your investing process, we have a 6-week trial of our macro investing community that's going from now until the end of the year. We only have a few spots left, though, so make sure that you guys are taking advantage of that. We open it up to 30 people, and I think as of right now, we are over 20, so there's not very many slots left. Book a call with me. Here's my calendar. The link's in the bio. It's free, so why not, right? All right, well, appreciate everyone for joining. Have a great rest of your Thursday as well as weekend. No stream tomorrow because it's Friday. I got to get my hair cut. And so we'll see you on Sunday for the Sunday macro wrap-up at 8 p.m. Eastern Time. Bye, everyone.